Good afternoon. My name is Martin Matsui, and very happy to be here this afternoon and thank Endowus for allowing all of us to hear from smart people, including my panelists. I also want to congratulate Enoch on his previous session. I saw him for 20 years at 9:15 in the morning at HKMA, so I'm not used to seeing him in the afternoon, but he still did a pretty good job. So let me introduce our panelists briefly. Laura is working for a multi-boutique firm called Natixis, and in particular, she's flying the flag for a value product managed by Harris Associates. Fabian is working for a company which I can describe that Vanguard is the Amundi of the United States. So he's working for the real Amundi, multi-asset manager with particular focus on emerging markets and Asia. And then Wei is working for a very research-driven firm called Dimensional. And we will pick her brains a little bit on some research product. So she is in charge of the research function, which is an integral part of how they produce alpha.
Thank you. I think that's a nerdy way to say I'm the nerdy one.
Good. So let me start off with asking a question that at HKMA we always ask each active manager. And all of these managers are, basically long only, no use of leverage, and liquid markets. So that is the general background. And what we always ask each fund manager is, what is your investment belief? What is the idea you have for your investment product that you hold dear and should lead to favorable outcomes? So let me ask Laura that first question.
Sure. So at Harris Associates, we are looking to invest in companies that are trading at a significant discount to intrinsic value, and also that are growing per share value over time. We also believe that buying great businesses at average prices is just as much value investing as buying average businesses at great prices, and we are fundamental investors and believe in active and patient investing. So that means our portfolios are relatively concentrated. They have a high active share, meaning that our holdings look quite different from that of benchmarks, and also that we tend to have a holding period of about 3 to 5 years, which is a bit longer.
Okay. Yeah. Florian?
Yes, thanks. At Amundi, what we can say is that we are active fundamental investor. Most of the time when you say fundamental, most people can understand that we are macro investor, and it's true. We are macro investor, and we spend a lot of time to try to understand the macro, understand the long-term valuation. But you need to look into, to do tactical asset allocation, you need to look into short-term. Short-term, you look at flows, positioning, and risk sentiment as well. So at the end of the day, when we say we are a fundamental investor, it doesn't mean we are not quant. You need quant today. Even if you like qualitative way of selecting stocks, bonds in your portfolios, you need quant to integrate and digest the data. You need quant to dice and slice the market momentum and understand what is priced in the market. And you need as well quant to build up your portfolio appropriately with risk budgeting. So in a way, we combine both qualitative and quantitative approaches in our fundamental approach.
Okay, thank you. Wei?
Thanks for having me. So at Dimensional, we are a pioneer in systematic active investing or factor investing, which means we try to outperform the market, not by relying on subjective views or predictions about the future, but by using a rules-based approach to structure our portfolios around those systematic return drivers that we can extract from current market prices. And I think what underpins our strategies is what, Martin, you were saying, one is our research rigor, which we developed really through our close collaboration with the top academics in financial science, including 5 Nobel laureates, and our 40+ years of implementation expertise to really implement those great ideas in the real world. And ultimately, I think what really matters for investors is that a good systematic active strategy can offer you the best of both worlds of active and passive. It can be more reliable and less costly than traditional active, while still providing you with that diversification, transparency, and scalability, which is why we're seeing a lot more investors embracing this type of approach.
Okay, thank you. So the topic that was assigned to us was, can the market continue to rally to new highs? So that was not a phrase that I would have used, but we have it for this panel. So let me ask Laura, in fact, how much time do your portfolio managers devote to what will happen in the equity markets over the next 3 months, which is what this question is suggesting?
Sure. So our portfolio managers don't spend any time really trying to, predict market movements, just because it's very difficult to get it right, especially in the light of kind of rising equity values over time. And so we believe that just by staying invested and allocating our portfolio towards those stocks that at least appear inexpensive is going to lead to far superior results than trying to kind of move in and out of cash. And I think there's been a lot, about new highs in the market. And actually, it's not that unusual in the US market to reach new highs. So if you look back over the past 50 years, for example, that is 600 months. 26% of those months, the S&P 500 reached a new high. So for an investor, if they had taken that as a sell signal, they would have benefited on one hand by missing 4 significant declines. So first, that was the dot-com bubble burst in 2000, the beginning of the global financial crisis in 2007, COVID lockdowns in 2020, and then the 2022 drawdowns in terms of the fears around inflation and interest rate increases. On the other hand, if they had taken every sell signal, aside from perhaps those 4, most of them would have been actually value destructive. So if you think about an investor that sold at all of the new highs and waited to invest at a better re-entry point, they would have actually missed the opportunity to make 200 times on their investment just by buying the S&P 500 and holding it for 50 years. So our discussions tend to be a lot more on kind of the growth value performance chasm, and when we see valuations that are wider, valuation dispersions that are wider than usual, we think that's a good opportunity for fundamental analysis to add value, much more so than trying to predict what the market's going to do over the next 3 months.
Okay. So let me ask the same question to Wei. So Wei, in fact, you wrote a paper on the subject about market timing. So how much time do you spend trying to predict whether the market will go to new highs?
We don't try to time the market or the factors in our strategies, but to your point, we have definitely done a lot of research on that point. So happy to elaborate later if there's any interest. But the only point I will add is to Laura's point that the new highs probably happen more frequently than people think, and then we actually show that if you look at returns subsequent to a new high versus just subsequent to any month ends, you get actually very similar returns, which shouldn't be surprising after all, because prices are forward-looking, and then they move very quickly such that they should be set such that the expected returns are positive. So to some extent, it's even puzzling that we're still getting those headlines around new highs whenever that happens. It's probably a good reminder that, read the news and headlines to be an informed citizen, but don't use those to inform your investment decisions.
Okay. Florian?
Well, Martin, I will have an issue because if I'm saying that I'm not trying to predict market direction, I will have an issue with my client and I will have an issue with my boss. I don't know which one is worse. So yes, we're trying to predict market direction, and the point is on time horizon. So we are not trying to time the market on very short-term squeeze and swings that at the end of the day you cannot anticipate. So if I don't have a positive daily P&L tonight, I will sleep okay. Mm-hmm. Nevertheless, I'm definitely, when I'm buying something in my portfolio, I have a high confidence and I try to employ my process and to have an investment rationale that this instrument will perform. Mm. So the point is, over the medium term, we try to extract appropriate risk-adjusted return for our clients in line with our mandate. So another way to say it, I think you should try to anticipate the macroeconomic drivers. You should try to derive it to what does it mean in terms of asset allocation, in terms of selection of companies. Should you try to to time the market, very complicated, and all the research that has been done. I've not seen yours, but I'm sure. At the end of the day, it's very complicated to time over the short term, but over the dynamic asset allocation, let's say 3 to 6 months, you should try indeed to anticipate a bit market performance. It works for the US, what you've been saying, so you sleep on S&P and eventually you make money. Less so with other markets, even equities, and especially emerging markets. If you sleep on emerging markets, if you sleep on China over the last 10 years, you're not making any return. So timing is important as well in our portfolios, and I would say maybe more multi-asset portfolios.
Right. Okay, good. So for the next section, I put together a table which I will refer to with our panelists. So maybe if we could have my table. Okay, so this table reflects a little bit the Endowus idea that we should be long-term investors. And what it shows is the 2015, 10, and 5-year performance of a variety of mostly equity asset classes. And you know, I'm looking at the long term because essentially everyone who's an individual investor or pension fund manager or even family office is thinking about retirement savings, and retirement savings is a long-term project. So this table, I think, has 4 observations to it. And the first is good news, and that is over the last 20 years, you've been paid to take risk. And the longer you've been in the market in a particular asset class, the better you've performed. So risk has paid off. I think the second message is that, unfortunately, there is a wide dispersion between which equity market class you went into. And we'll come back a little bit on the sources of underperformance, particularly in emerging markets and our own local market, the Hang Seng Index. I think the third point would be that the value factor has underperformed. So I think everyone on this panel thinks that they are skilled in identifying value assets, cheap assets. So we need to understand a little bit better their views on why that particular investment style has not delivered better results, and will that change. And then I guess the last takeaway is US exceptionalism. So it really is amazing, 2015, 10, or 5 years, the outperformance of large cap US stocks versus pretty much every other asset class. So with Harris Associates being a specialist in value, let me first ask Laura about her view. And then in addition, Laura previously was with the asset consulting firm called Cambridge Associates. So maybe, you know, she can put her hat on as value and asset consultant. What do you think about the value underperformance, and when does that turn?
Yeah, so certainly for over a decade, value investing, and you know, the returns have not been bad, but they've underperformed kind of growth, and they've underperformed kind of a broader blend benchmark. So I think that if you look at kind of the prior decade, a lot of values underperformance could be explained by kind of macro fears and the scarcity of global growth. So if you think about, for example, going back to 2016 and a lot of the uncertainty around Brexit, 2015, the devaluation of the yuan, 2018, trade war fears, 2020, COVID. And so these were periods where investors really valued stability and growth. And value stocks, on the other hand, during that time period tended to be more economically sensitive or cyclical. And of course, we had, you know, this period of, you know, very low interest rates. And so we had investors that were fine to pay a high multiple to get higher cash flows, even if they were to come, you know, much further down in the future. You know, if at all. So, and then more recently, we've had 2022 was a pretty good year for value, at least on a relative basis. And then 2023 and into this year, essentially that has reversed. So with a lot of the outperformance of essentially I guess a small handful of mega cap tech stocks. So, going back, sometimes it feels like it's never going to change, but style leadership does go back and forth. And so we do think that we are due for a period of more sustained performance for value equities.
Okay, so Wei, your investment platform is value, small cap, and profitability.
Exactly.
So,
As long-term drivers.
okay, so what is your take on value's long winter?
Yeah, I think to some extent it's tempting trying to pinpoint, say, one story, right? Explains all the performance. And we're seeing lots of stories out there talking about, low interest rate, inflation, economic growth, or intangibles, right? Moving from the service, more capital-intensive type of industries into more service-oriented. But in the end, as we go into the data and then look more closely and look at longer term, a lot of those stories don't really hold water, or at least don't really give you the full picture. I think in the end, it is to some extent, an inconvenient truth that when you think about higher expected returns, value outperforming growth, say on an annualized basis, say 4.5%, the path to that long-term average is far from a straight line. Right? Now, it's the same thing with equity premium, actually, right? If now everybody is focusing on S&P 500, saying, well, it has done so well 10, 15 years, but then if you think about the last decade, ending in 2009, everyone was asking, is equity dead, right? Because S&P 500 was returning negative 1% over the entire decade. So I think that's actually a good reminder not to, or at least to avoid the recency bias and then not to extrapolate those performance on the going forward basis. The way we set our expectations, it's really go back to the fundamental principles, right? What drives the expected returns? And if you're paying a lower price for the same set of expected cash flows, then the discount rates for those cash flows or that expected return on those securities has to be higher, right? That's very much a fundamental principle that applies to anything investing or anything. If you buy properties, if you buy anything as well. So I think at the end of the day, we recognize there's a lot of volatility around these premiums, but it doesn't change our expectation that those premiums should be positive. And the last thing I will add is that I like how data-driven you are, Martin. You show a lot of numbers there. I think those indices are used for references for sure. But in terms of what investors actually get when they have those exposures to value or other multi-factors, their experience can still be much worse or much better than what the indices show. So at least in our experience, we see that if you're able to integrate multiple factors, to your point, size, value, profitability, if you pay attention to shorter-term signals like momentum and so on, and then if you stay disciplined to capture those huge rebounds, which happened in 2021, 2022, to Laura's point, even during a long period of underperformance, then you can do still much better than what those value indices are showing. So I think that's only telling part of the story.
Okay, thank you. So maybe we can put the table back on as I ask Florian this very difficult question, which is, when does emerging market underperformance turn around?
That's a good one. Okay, so most of people are saying, well, it's surprising because in emerging markets you have growth, you have economic growth, but when you look at performance on the market, it's disappointing, or at least it's far below what the US has been able to achieve and developed markets in general as well. I think two things to mention. One, you need political stability, you need political understanding, regulatory understanding, which is one. Second is earning delivery, and I think US exceptionalism is very much on the earning delivery of the companies there compared to other companies elsewhere. So on the emerging markets, then maybe another same question is, do you need to diversify away from the US in your portfolios? Well, first, even if you add a volatile asset class to your portfolio, as soon as it's not 100% correlated, it will bring diversification benefits. So you will have a lower volatility and a lower drawdown risk. Second point, when we look at emerging market and you try to dice and slice, because when we look at it from now, China is having a big impact on emerging markets. Let's say you position yourself 3 years ago. So everybody is 3 years younger. We should be pretty happy about that. Only issue is that you have a face mask on. But you position yourself mid-21, and you look at last 20 years, MSCI China from 2001 to 21, 10% annualized return. Eventually, you look at it today, after 3 years and 50% drawdown, looks quite ugly. And I quite resonate with what a previous panelists have been saying. We are at max bearishness in terms of sentiment, in terms of market momentum on China. When you look at investment cycle, and this is coming back to the timing, expansion phase, when growth is accelerating, most of the time post central banks cutting rates. Expansion, emerging assets, Chinese assets, but emerging assets in general are performing double digit. But they are going deep down during drawdowns. So there is this kind of offsetting factor over the medium term that we are saying. So 3 years ago, I'm not sure you asked the same question on China because China was doing okay. Eventually, when you look at emerging markets and you buy an emerging market via an ETF, for example, you have 1/3 of China. Well, you used to have 1/3 of China. You have closer to 1/4 of China now. Why? China underperformed, so it has been diluted in EM. Yes, but you may miss the other side of the story. You read in the papers, S&P is all-time high. Nikkei is all-time high. You may have missed India is all-time high, India in equity. Taiwanese equities are all-time high as well. So we should make sure that when you look at emerging markets, you look at, of course, different stories, different countries, idiosyncratic stories at the company level, but you have fantastic stories and fantastic performance on the market. So I think the question is not, should you diversify away from the US, is how much? And this will depend on your investment horizon and your risk tolerance. And how, and I think how, especially on emerging markets, where it's less liquid, less efficient, you need an asset manager and potentially an active asset manager to get rid of the bad stories. And if you get rid of the bad stories, you can eventually focus on those big opportunities. So I'm not answering to when you should step in, but I think you should have some. And I may come back on when later on during the panel.
Okay, good. Okay, thank you. Let me ask a indelicate question, which I think all of you who are asset allocators may eventually need to ask your fund managers. And then, when is it time to get out? So in other words, we are all active managers on this panel. They've described their investment thesis. And when do you decide that, as a rule of thumb, that the portfolio manager does not have skill? So theoretically, this is a very difficult question because, according to some papers, it could take 50 years to decide whether this underperformance is due to lack of skill. But since we all have investment committees we need to report to, let me just ask for rules of thumb of when investors should throw in the towel on an active product. Laura.
So we tend to frame our clients' investment objectives of at least kind of a 5-year period. But sometimes it's difficult to just look at one 5-year period in isolation. There is some endpoint sensitivity. So an analysis we do run on a regular basis is you basically look at rolling periods. So you could take rolling 5-year periods for a fund all the way back to inception, and you can calculate the percentage of times that the fund manager is able to outperform on a 5-year basis. And I think what you'd want to see is that as you extend that time horizon, the manager is much more likely to be able to outperform. So over a 1-year period, that's where it's a little bit tricky. Like maybe a fund manager could outperform, 50, 60% of the time. When you go to higher figures, rolling 10-year periods, you would expect, an active fund manager to be able to outperform, I guess, almost 100% of the time. So that's, one way that we look at it. And I think the other thing I would just caution, just in the sense, I guess, because I'm talking more about U.S. equities today, is just that, passive investing doesn't mean you're not taking risks. So certainly a lot has been said about, higher concentration in the S&P 500 than it used to be. It's obviously dominated by, mega cap, tech names. And so some people think of risk in asset management or active management as basically doing anything that's different than the S&P. But we think of risk also more along the lines of am I going to lose money? And we think again that investing in the S&P at least is riskier certainly than it has been in the past.
Okay, Wei, what do you think?
Well, it's funny that you mentioned 50 years. If you ask Professor Ken French, you know, the founder of French Data, he'd probably say something like 400 years. Sometimes I joke that long-term just means one more day than what investors are willing to give, which is why I think it's quite important to have financial advisors who are, you know, conflict-free and then really help investors stay in the seat. I fully appreciate that not everybody has, you know, decades of years, you know, decades of periods to work through. I think what can be useful to compensate for that lack of history or the time frame is to look at the full list of funds that the managers has, you know, including the disappearing ones. I think that there's a lot of survivor bias when you just focus on the winner funds, because in the end, every manager can probably point to a couple of bonds that have done really well recently. And then in our research, when we look at industry funds, you do see that, you know, over a 10-year period, almost a third of the funds disappear, you know, and then they disappear oftentimes because they don't outperform. And then the winners are certainly in the minority, probably less than 1/3 over like a 10-year period. So I think in the end, if you look at the full body of work from an asset manager, look at, you know, how their full list of funds that have performed, I think that could be useful for the due diligence process. The other thing that's more specific for systematic managers like ourselves, I think it's quite important to think about what you are evaluating. You need to be evaluating the research underpinning the strategies, and that you don't want to see just 3 years, 5 years of data. You want to see that managers are actually getting their hands dirty at as much data as possible, you know, to give you that out-of-sample test to look at all the different economic cycles. But at the same time, you want to evaluate the implementation, whether the managers are able to give you what they promise to deliver, right? Are they able to maintain that consistent focus in a risk-controlled and cost-effective manner? That you can actually see reliable evidence over even shorter periods and what they're doing, and then also the performance during different environments. I think that can be quite telling as well.
Great, thank you. Florian?
So basically, why should you fire us? Okay. First, you have red flags when you do due diligence of active fund management, for sure, change of portfolio managers, change of process in the bad way, or less confident, operational issues, governance issues. So let's say, like, okay, those are the big ones. Let's focus maybe more on the rest. Risk tolerance, and it's interesting what you said, Laura. It's like when you go in ETF, you have risk as well. So you have market risk, you have volatility as the same. But then if you cannot live with a short-term underperformance versus market, it means that you may have to go for ETF. And it means that you're closing the door to any potential alpha over the long run that the manager is able to deliver. Second point is, do you really understand the underlying strategy? So the point on the timing, we come back to that. Am I buying the strategy because it has been outperforming significantly? So am I buying the strategy at the max? Relative returns, that's the peak the strategy can deliver? Or am I capitulating after a severe period of underperformance? So basically, what are the biases in the process, in the approach, in the philosophy of the underlying manager I can understand, and what are the market momentum and market delivery, and how can I explain? How does it reconcile? So this is important as well. For example, the market concentration we're seeing in the US. I was very happy in March to see a bit of broadening of the leadership in the US markets. But eventually in April, we are not getting exactly the same signals. We are back with very large cap outperforming the rest again. In this environment where concentration of market performance and earning per share expectation as well is very concentrated, it's complicated for an active asset manager to outperform, apart if you're betting on specifically in your thematic on those stocks. Why? Because you have valuation discipline, and it may get to some pocket of excessive valuations. And two, because you have portfolio concentration rules. You cannot go too much into one stock, for example. So I think the question is, what kind of combination between active and passive you should eventually reach? So taking my outsource CIO hat to answer to this, I think you need both. You need a combination of active and passive. Why do you need passive? You need passive to get core allocation in efficient markets. You will save on fees, and it's very nice for capital appreciation over the long run, retirement in mind, school for the kids in mind, and so on. So core allocation to efficient markets. You can even tilt your strategic asset allocation on countries. You like India, you like Japan, you can tilt up those via ETF. You can even look into factors if you like. But then you need active managers for satellite pockets. Two type of active managers in our view. For less efficient, less liquid markets like emerging market, Chinese markets, for example, they will be able to get rid of the bad stories and pick the ones that are a bit more appealing. And the second is liquid markets, but high conviction, high tracking error. You get some leeway from the benchmark, and you get some high conviction on the liquid markets. So this is a bit how I would answer to this.
Okay, good. Thank you, Florian. So we could spend a lot of time on AI, but the advent of AI, to me as a layman, seems to pose quite a threat to dimensional. So in other words, you don't need to have 4 Nobel Prize winners on the payroll. You can enlist ChatGPT. So isn't it possible that with advent of AI, investors can recreate your expensive factor research by using cheap factor research?
Well, the good news is that you can already access those factor models for free. You know,
Right.
Ken French and Jing Pharma, they maintain a data library. You can Google it. You know, all the factor returns all up there. The truth is there is a lot of data and research in the public domain, and we proudly contribute to that ourselves. But at the end of the day, the factors themselves are not investment strategies. There's a lot of expertise that's needed to interpret that data, to interpret the research, but also to think about how to translate those research insights into actual portfolio designs and actually to be able to deliver those value adds in the real world, right? With a lot of the transaction costs and then the implementation costs. I think that's really where the expertise lies. But I think going to your question more specifically around AI and the rise of big data and technology, I think it's definitely an exciting time for people like myself, data nerds like myself, lots of data to work with. We often say that the last chapter of finance is never written. But at the same time, I think it's good to be kind of mindful that in the end, with more data and with more computing power, it doesn't mean more investment insights. It's actually quite easy to find things that have worked in the historical data just simply by chance. And it's a lot harder to find things that can actually add value for clients on a going forward basis. So I think actually in this era, it's even more important to have both the technical skills to be able to disentangle signal versus noise, but also actually have that discipline to not constantly tweak your model just to fit the historical data better. Where we do see more promising use cases for AI is in terms of increasing the efficiency in our investment process. We're already using machine learning techniques for data error detection and to control our data quality, to read text from financial statements and so on. So I think those will certainly lead to more efficiency in our process and lead to more scalable, lower cost products, which I think will ultimately benefit investors. So definitely very exciting.
Okay, thank you. Florian, you started at the very beginning to talk a little bit about AI and your investment process. Any couple of sentences you would like to add to that?
No, I think I will relate a bit to what was said initially. To get efficiency and to save costs, it can very much help. So within the full investment process, check data quality. You mentioned about it. I think it's very crucial because the amount of data we have to deal with is increasing drastically. The second point is everything linked to reporting, performance attribution, market commentary, everything that used to be semi-manual or semi-automatic, but then semi-manual, if you want to see it clearly, we can improve on this one. And so we can spend more time on value-added areas. So I think AI is progressively implementing within the company. We have been starting, strangely, not by investment process, but actually the quicker win that we've seen was on the middle office, on the finance, on the investment specialists, on the reporting side, where you can streamline a lot of processes that were manual. And we have been starting with data quality on the investment process on our side.
Okay, good. Thank you. So turning to questions from the audience, here's one for Laura. and that is, have long-term investors changed their strategy due to ESG considerations? How?
Well, I think it depends on the manager. I think for us at Harris Associates, we've actually, so governance has been a very important part of our investment process since the beginning. So we are looking for management teams that are aligned with shareholders. That's always been the case. And then I guess for the E and the S, we have always factored that into our evaluation. So that doesn't mean that we wholesale, exclude, certain industries or companies due to ESG reasons, but essentially we factor that into our evaluation analysis. So really that hasn't changed, going back. But I think the difference is maybe that we've formalized it a little bit more. We've been able to kind of communicate that, better to our investors, keep track of it more, keep track of our engagements, et cetera. So I think, again, we're a fundamental manager, no real kind of fundamental change in terms of ESG, but formalizing it a little bit more into our process.
Okay, good. Here's another question. Hang Seng Index is at the same level it was during the handover in 1997. Chief Executive John Lee put a committee together to revive the Hang Seng Index Hong Kong Stock Exchange, but nothing material transpired. What else can be done to revive the Hong Kong market? So maybe question for Wei. Your strategy relies a lot on very detailed market structure analysis. So you may not have thought about this, but what are the ideas that may be worth pursuing?
From the market reform perspective?
Yes.
Or, I will not pretend to be an economist or a regulator from that perspective, but I would say that a general point about how, like earlier, I think Florian said something similar about that disconnect between, say, economic growth and equity returns. To some extent, at least from our research perspective, it's not that surprising. Because in the end, we have done some research showing that even if you had perfect foresight of economic growth, and you only invest in markets with above average growth, you're still not getting better returns. Because in the end, a lot of those expectations are already baked into today's market prices. So that's why trying to outguess market prices is a very expensive and then difficult game to play. So I think I can only answer from more of an investor perspective. We don't try to say place any country bets across these markets. So what we will do is to be broadly diversified across these markets, and then within those markets try to tilt towards these different premiums. And the good news is that we do see that the type of premiums that we pursue, size, value, profitability, they've been pretty strong in emerging markets, including in Chinese and Hong Kong markets as well.
Okay, Florian, what's on your wish list?
Well, you can, let's say, position yourself and forget everything that happened in China over the last 2 years. Okay, you look at the business, the company business. Let's say large cap tech companies quoted in Hong Kong, Chinese companies. What are you looking at? You're looking at a lot of cash in the balance sheet. You look at significant undervaluation versus DM and versus EM counterparts. You look at companies that are buying their share back. So buybacks is not only a US story or a Japan story, it's actually happening in China, and it's new, and it's shareholder value. And you look at companies that are delivering cash flows at a double-digit rhythm. Okay, so, but what is the government action of late? Government action of late this year is preventing from short selling, national team stepping in to make sure that market is trying to get a bit better in terms of sentiment. Monetary policy easing over the last 2 years. The only central banks have been doing so. Moderate fiscal easing. If you position yourself and you forget about the short-term pain, I believe from an investor point of view, you have more opportunity cost of having no China than having a drawdown risk of having a lot of China as of today. So it doesn't mean that you should have a significant allocation to China, but having no China I think is a mistake. And if we do the round table in 3 years' time, I guess that we can conclude this.
Okay, good. So that's a promise. 3 years from now, we will try to put this team together. So thank you very much for your time, and I would like to thank the panelists and Endowus for allowing us to talk to you.